Welcome to the 9th episode of Let's Talk About, the LuxCMA podcast series dedicated to high-level insight and developments in capital markets and sustainable finance. My name is Chiara Caprioli. I am the regional head for France, South Europe, Middle East and Africa at the Luxembourg Stock Exchange, the leading exchange for international bonds and sustainable bonds too. Today, I'm here with three special guests who will be joining us to discuss an exciting topic, blue finance and blue bonds in particular. As we gather to discuss this strategic topic at the intersection between finance and sustainability and community impact, I would like to take a moment to reflect on why blue finance is more than just a buzzword. Ladies and gentlemen, oceans cover more than 70% of our planet, providing essential resources and services that are crucial for life. From supporting biodiversity to regulating our climate, the health of our oceans directly impacts our well-being and our economic stability. Yet, we face immense challenges such as overfishing, pollution, and climate change that all threaten our vital ecosystem. I guess we all agree that investments are needed in areas such as marine and coastal ecosystems, sustainable fisheries, and ocean-based renewable energies to promote resilience in the face of climate change and to improve the economic conditions of coastal communities. But today, oceans only receive a fraction of global sustainable finance. So looking at blue bonds alone, total issuance in 2024 was around $5 billion, of which sovereign issuance took up around $3 billion. So a niche market, but one that several studies expect to grow by around 18 to 22% annually, reflecting rising investors' interest in marine and water sustainability finance. So I'm excited to give the floor to our guests that are here with me today. Vincenzo Bruno, Director of Capital Markets and Sustainable Finance at PricewaterhouseCoopers Luxembourg. Isabelle Delat, Chief Executive Officer at LuxFLAG. And last but not least, Thomas Tomasic, Senior Associate at Dechert, Luxembourg. So, Thomas, let's start with you. Let's start with the fundamentals. Blue finance means different things to different stakeholders. How is it being defined today, and where do you see the biggest misconception, if there are any, of course?
Thank you, Chiara. From a structuring perspective, blue finance today mobilizes public and private capital to support ocean and water-based projects that generate clearly measured environmental and social benefits, ranging from sustainable fisheries and marine biodiversity protection to coastal resilience and clean shipping. Key frameworks such as the International Capital Market Association 2020 Blue Bond Principle and the United Nations Environment Programme Finance Initiative's Sustainable Blue Economy Finance Principle build on the green model but introduce ocean-specific eligibility criteria. A common misconception is that blue finance is simply green finance rebuilt for ocean projects, when in fact blue frameworks often require additional specific assessments, such as marine spatial planning and social safeguards that go beyond typical green requirements. From a regulatory perspective, blue finance is emerging as a distinct subset of sustainable finance that demands tailored taxonomies, disclosure rules, and risk management guidance. For instance, the European Commission proposed EU Blue Taxonomy in 2023, which aims to define technical screening criteria for ocean-related activities, mirroring the green taxonomy but tailored to areas such as aquaculture, offshore wind farms, and port infrastructure. The biggest misconception here is that the existing green finance regulation automatically cover blue activities. Regulators should address unique ocean-related risk and guard against both underutilization of blue credential and blue washing, where projects overstate the positive ocean impact. Finally, from an issuance perspective, blue finance means tapping capital markets with instruments that signal a clear commitment to ocean stewardship and resilience. Issuers should namely provide rigorous impact reporting, secure third-party verification, and maintain post-issuance transparency.
Thank you for this clarification, Thomas. You seem to be saying that many blue bonds are built on broader and pre-existing green bond frameworks. So what is it that genuinely differentiates a blue bond from a green bond, beyond, of course, the use of proceeds? And where do you see any added product-specific complexity?
Of course. In practice, a blue bond must go well beyond the traditional use of proceeds approach of a green bond by meeting blue-specific safeguards and impact requirements. Under the ICMA blue bonds principles, for example, eligible products must demonstrably protect and restore aquatic ecosystem rather than more generic land on energy-based activities. Issuers are also expected to deliver no net harm to marine biodiversity, measure blue carbon sequestration in habitats, and engage coastal communities in project design and monitoring. These criteria already exceed the scope of most green bond frameworks and align with emerging EU taxonomy criteria for pollution prevention and control and healthy ecosystem, which the EU Commission is currently refining for aquatic environments. From a reporting standpoint, blue bonds require bespoke impact metrics and regular third-party verification by specialists in marine science rather than broader climate-focused consultants. These indicators demand new data collection protocols and methodology that issuers and arrangers must build into their legal documentation and prospectuses. In Luxembourg and the wider EU market, this added substance introduces several layers of complexity. First, the EU taxonomy application to aquatic projects remain under consultation, forcing arrangers to navigate in an evolving policy landscape. Second, the absence of an ESG framework dedicated to blue activities leads issuers and arrangers to use comfort letter to demonstrate alignment. Taken together, these marine-specific eligibility tests, impact reporting, obligation, and regulatory uncertainties mean that blue bonds demand more scientific, legal, and stakeholder engagement work than their green predecessors, and contrary to the frequent misunderstanding that converting an existing green bond program into a blue one involves minimal extra work.
All right, so you described a product that is materially more complex and scientifically demanding than traditional green bonds. Doesn't that suggest that blue finance may need its own regulatory identity rather than being treated as a subset of sustainable finance? And do you think we need a dedicated blue taxonomy?
Well, there is an ongoing debate over a standalone blue taxonomy versus folding marine activities into existing EU frameworks, which largely depends on market clarity, regulatory alignment, and legislative agility. On one hand, a dedicated blue taxonomy could certainly sharpen the focus on ocean-specific risk and create bespoke screening criteria for assets. However, let's be realistic, standalone rules could risk fracturing the EU unified sustainable finance architecture and duplicating work under the existing regulation. By contrast, integrating blue activities via a specialized annex or delegated act within the existing EU taxonomy offers greater coherence. The current delegated act already captures sustainable use and protection of water and marine resources under its environmental objectives. The platform on sustainable finance has signaled its intent to refine technical screening metrics for aquatic projects, including quantitative thresholds for water quality improvement and safeguards taking on the no net biodiversity loss. Aligning blue criteria in this way would avoid multiplying taxonomies and leverage the EU established reporting infrastructure. On the Luxembourg market, issuers can already list blue bonds on the Luxembourg Green Exchange under the Green Sustainability and Sustainability-linked bond rules. As the EU taxonomy evolves to embed clearer water and marine threshold, Luxembourg could certainly pilot blue innovation favoring product recognition. It is all about moving gradually in parallel to the regulatory and hence scientific framework stabilization and having in mind to strike the optimal balance between specificity and regulatory harmony.
Thank you, Thomas, for setting the scene around blue finance, and now moving to Vincenzo and moving closer to the core of finance. What instruments are there, and to what extent are blue bonds emerging as robust products to channel funds into specific blue projects?
Yeah, thanks, Chiara. On the capital market side, the main instruments are definitely the use of proceeds bonds, so blue bonds issued under a green or sustainability bond framework, as Thomas previously mentioned, where proceeds are ring-fenced for eligible blue projects. And sustainability-linked bonds, where the coupon can step up or step down based on the performance against blue KPIs, such as water quality, pollution reduction, or marine ecosystem outcomes. Obviously, the same logic extends beyond bonds to loans and project finance structures. Additionally, there is an instrument that is worth mentioning that is issued particularly at sovereign level, and it is called debt for nature swap. In such context, a country can refinance part of its debt on better terms and commit in parallel to allocate some of the savings that it achieved to ocean protection, often with clear targets under a transparent and prescriptive framework. Therefore, I can say that blue bonds are indeed emerging as robust products because they are building on the established architecture of sustainable bond market, especially the discipline around the use of proceeds, project evaluation and selection, management of proceeds, and reporting, rather than reinventing everything from zero. What has really helped and brought clarity for blue bonds, aside from the emerging regulation around taxonomies, is the publication of the Global Practitioners Guide developed by IFC, ICMA, the United Nations, and the Asian Development Bank, among others, which provide clearer blue eligibility criteria and typologies, suggests KPIs, and sets expectation for impact measurement and transparency, which are exactly the ingredients that investors look for to avoid blue washing and price risk with confidence. As said earlier, typical KPIs that blue bonds target to reaching their impact are to improve water quality, support pollution reduction, or enhance marine ecosystem outcomes.
Thank you, Vincenzo. It seems then that the market architecture is maturing and that investor confidence is now strengthening. So if we move to practice, can you share a couple of successful or otherwise meaningful examples of blue bonds?
Yeah, absolutely. As said previously, over the years there have been different structures of financial instruments that have emerged. The first ever blue bond was issued by the Seychelles in 2018 and structured as a classic use of proceeds model. In that case, the proceeds were earmarked to fund sustainable marine and fisheries projects, including expanding marine protected areas, improving governance of priority fisheries, and supporting the broader blue economy. Proceeds were channeled through dedicated vehicles, the Blue Grants Fund and the Blue Investment Fund, managed by local institutions, linking the bond to clearly identifiable project pipelines. A second example was issued by SOR, a major French environmental services company, in September 2021, which issued basically a 950 million sustainability-linked bond, which was set up in a way that the financing costs were benchmarked against a certain performance of selected KPIs. The KPIs selected in that case were water withdrawals KPIs and carbon intensity. And basically, if SOR failed to meet certain sustainability performance targets by certain relevant observation dates that were described in the legal documentation, the structure contemplated that the issuer could pay a coupon step-up of 25 basis points per annum. So another example I would like to mention is a landmark debt for nature swap proposed by Belize, which basically issued an external financing to reduce its external debt by around 10% of their GDP and materially improved debt sustainability of the country. Mechanically, Belize used new financing to buy back around 550 million bond at a discount. In return, the issuer in this case committed to spend the savings obtained in refinancing about $4 million per year on marine conservation until 2041 and to expand marine protection. Finally, to conclude, we have seen recently more and more blue bonds issued not only to protect oceans and marine ecosystems, but rather to channel funds for investments and expenditure in development, maintenance, and retrofitting of sustainable water and sewage management systems. Like, for example, it is the case for the largest bond to date issued by Sabesp, a Brazilian entity, amounting to 1.35 billion and listed on the Luxembourg Stock Exchange, on the LGX, the dedicated platform for thematic bonds of the Luxembourg Stock Exchange.
That was a very nice overview, Vincenzo. Your example highlights how adaptable blue finance instruments have become, which naturally brings us to the next dimension of the discussion. So, Isabel, you represent a labeling agency. How do we measure the credibility and the impact of blue finance investments, and what metrics should we prioritize?
Thank you, Chiara. As a global labeling agency, we look at blue finance first and foremost through the lens of credibility and discipline. Impact of blue finance cannot rely on a single headline metric, especially because marine ecosystems are place-based and complex by nature. Instead, it requires a layered and structured approach. The foundation is always transparent allocation and use of proceeds reporting. Investors need clarity on how much capital has been allocated, to which categories, how unallocated proceeds are managed, and how funds are tracked internally. Without that transparency, everything else becomes secondary. Beyond allocation, we then move to activity-linked outputs and outcomes. At the most standardized level, this can include metrics such as volume of wastewater treated, reduction in pollution discharge, water saved, or hectares of marine ecosystems protected. These are tangible and measurable. At a more sophisticated or project-specific level, we may see KPIs related to improvements in water quality indicators, sustainable fisheries governance metrics, or resilience indicators for coastal infrastructure. However, this must always be clearly attributable and based on reasonable assumptions. We should avoid speculative blue finance claims that cannot be robustly verified. Finally, governance is central. Credible blue finance requires strong project selection processes, environmental and social risk management, external review where appropriate, and consistent post-issuance reporting. In our view, success in blue finance is defined less by ambitious impact statements, more by transparency, consistency, and discipline over time.
Which brings us back to the fundamental role of frameworks and governance, an area in which Luxembourg has positioned itself strongly via its ecosystem. What would you expect from Luxembourg in gearing up its market infrastructure to accommodate the scaling up of blue finance?
Luxembourg's role in blue finance is best understood as that of an enabler and amplifier rather than a direct owner of blue assets. As an example, in 2018, Luxembourg founded the Blue Natural Capital Financing Facility, which enables impactful investment that advance sustainable blue natural capital initiatives worldwide. First, from a capital markets perspective, Luxembourg provides strong infrastructure for listing and visibility. The Luxembourg Stock Exchange, via its Luxembourg Green Exchange, plays an important role in increasing transparency and helping identify thematic instruments, including blue label bonds, within the broader sustainable bond universe. This improves market visibility and comparability. Second, Luxembourg has deep expertise in structuring and governance. The ecosystem supports a wide range of sustainable finance vehicles, from bonds to funds and blended finance structure, and aligns closely with international standards. That institutional depth is particularly important for emerging markets and small island developing states seeking access to global capital. Third, Luxembourg benefits from a strong network of development finance and impact-oriented actors. Institutions such as the European Investment Bank, EIB Global and various blended finance platforms, headquartered or active in Luxembourg, contribute to de-risking structure and mobilizing private capital toward water and ocean-related investments. So Luxembourg's value lies in credibility, structuring expertise, and international market access, creating the conditions under which blue finance can scale responsibly.
So the ecosystem may be in place, but the real question is whether blue finance can now move beyond its early momentum and reach critical mass. If you were to look 3 to 5 years ahead, Isabelle, what needs to happen for blue finance to move from a niche to a more mature and scalable market? And what would success look like from your perspective?
Looking ahead, scaling blue finance is less about creating new labels and more about strengthening fundamentals, with labels serving as credibility tools, not as hands in themselves. What the market really needs is clarity and coherence. Investors and issuers benefit from consistent definitions of what qualifies as blue within existing sustainable finance frameworks. Fragmentation creates uncertainty. Alignment builds confidence. At the same time, the real bottleneck is often not capital but projects. In many coastal and emerging economies, there is strong investor interest but fewer well-prepared, bankable projects with clear governance and long-term viability. Strengthening project pipelines will be decisive. Another essential element is robust and social risk management. Marine ecosystems are particularly sensitive, and scaling finance must go hand in hand with precautionary approaches, stakeholder engagement, and scientific integrity. Finally, transparent and credible reporting will determine whether investor confidence deepens over time. Consistency in allocation reporting, realistic outcome metrics, and clear disclosure of risk are what transform a niche theme into a mature market segment. If in 3 to 5 years blue finance is treated as a normal and disciplined component of sustainable finance, assessed with the same rigor as climate investments, that would be a clear sign of success.
Thank you, Isabelle, and many thanks to all our speakers for sharing their valuable insight on this fascinating and fast-evolving topic. If there is one takeaway from today's discussion, is that blue finance is no longer conceptual, it is already operational. What started in 2018 as a pioneering sovereign issuance has now evolved into a broader and promising market. The blue bond universe is still relatively small. It is measured in tens of billions rather than trillions, but precisely for that reason, the growth potential is significant. Specific investment needs are estimated hundreds of billions of dollars per year globally, whether for coastal resilience, sustainable fisheries, wastewater treatment, or maritime biodiversity protection. So a huge opportunity to fill the financing gap. Thank you for listening. If you enjoyed this episode, please rate and review us on Spotify and join the conversation on LuxCMA LinkedIn page. You can also watch this episode along with all of the previous one on LuxCMA YouTube channel. Stay tuned for our next episode where we will be diving into gender finance, exploring how capital markets can drive greater inclusions, equality and impact. Until next time, keep thinking green and blue.